Yes, दोस्तों, very good evening. Hope you all are doing really well. So I welcome you all to this session in which we are going to cover chapter number 17 and chapter number 18, the questions of these particular chapters. So I hope I am audible and visible clearly. Please confirm me on the chat box if I am audible and visible clearly. Yes, please confirm me on the chat box if I am audible and visible clearly. I'll also check from my end. Yes, perfect. Good afternoon. Okay. So very good afternoon everybody. Hope you all are doing really well. This is Supreet Agrawal, your faculty for ACCA AA, AAA and law subjects, and today we are going to conduct a very important session because today we are going to cover the questions from chapter number 17 and chapter number 18 from your AA syllabus. And my dear friends, this particular session is going to help you a lot while you prepare for your AA paper. So be with me till the end of the session and I assure you that you will be feeling confident in chapter number 17 as well as chapter number 18. Okay, perfect. So now my dear friends, when we discuss about chapter number 17, the name of the chapter is accounting estimates. The name of the chapter is accounting estimates, and you know the beauty of this chapter is that a lot of students face trouble in understanding this chapter. But sir, how is this the beauty of this chapter? Because see, this particular chapter is one such topic where you can actually prepare yourself to score good marks and to target the AIR as well as the world rank as well. Why do I say that? Because this is one such topic. In fact, these two are those topics which a lot of students leave in my experience. I have particularly seen the students whom I interact with at the last days of their preparation. I generally get to know that they have left these two topics. The reason is plain simple, because they were unable to understand it. So my dear friends, just in case, if you have not understood it, I would really suggest you to go through the marathon session. So where can I find this marathon session? So you can find this marathon session in the description box only. I have input the link of this particular marathon session and you can watch it. Now when we talk about the another problem is that the questions of these particular chapters, the questions are little difficult to frame. As in, what happens is, when we read the questions of these two particular chapters, the student might know the answer to this particular topics, but when it comes to framing the answer in the audited terminologies, then they face a little bit of trouble. So what we need to understand here is that today's discussion is not going to be just about how to complete the questions of these particular chapters or how to answer the questions of these particular chapters. It is more on how do you draft the answer, what all terminologies you need to use in your answers. So let's quickly jump onto this particular chapter, which is starting from 171 and we have to complete till 180. 171. Let's jump into that. Okay. And wherever you face any trouble, please feel free to let me know on the chat box. I would be happy to discuss it with you. 171. Few more pages. Okay. Really sorry, this was summary notes. Let's jump to question bank. The chapter number 17 and 18. Yes, 134. So what was that? That was summary notes. So were you telling us that your summary notes are so beautiful, handful and handwritten also? Yes, I was just bragging a little bit, my dear friends. Yes. So how can we access those summary notes? So you can find the link in the description box. You can let me know, just in case if you face any trouble. Do let me know in the WhatsApp number that has been mentioned in the description box. Now let's come to chapter number 17. When I talk about chapter number 17, that is accounting estimates. When I talk about chapter number 17, accounting estimates, so where we can use the accounting estimates, so you might have heard that we can use it in the form of depreciation calculations, useful life analysis also, right? Then you might have understood it at the time of gratuity calculations also, right? So there are so many things. Now let's discuss about it. An accounting estimate is defined by international standards on auditing as an approximation of the amount of an item in the absence of a precise means of measurement. What do we understand from it? Where there are no precise means of measurement, when you do the approximate calculation, that is known as accounting estimates. For example, if I have to ask you that say this is one of my watches, okay, this is one of my watches and this is an investment for me. Let's consider that this is an investment for me. Okay, now I need to depreciate it. When I need to depreciate it, I need to understand what is the useful life of it, how much depreciation should I charge on year to year basis following the matching principle of accounting. my dear friends, there is no particular fixed amount that could be charged here. We just make an approximation, and that is why depreciation is now also accounted for as accounting estimates only, right? So now let's discuss about the first question. Required. State the matters you would consider and describe the audit work you would perform in order to ascertain whether the following are fairly stated in the financial statement. So what we have to do? State the matters we would consider, that is the first point that we need to answer, and describe the audit work, that is the second answer. A lot of students makes this mistake that they answer for the second requirement but not the first requirement, because first requirement is also what do you consider, and then how will you prepare your audit work. In the financial statements of a company which assembles a range of powered garden tools from bought-in components. Okay, number one, a provision for warranty claims. A provision for warranty claims, is this an accounting estimate? Yes sir. Then depreciation expense on a compressed air system purchased during the year for the assembly department. Okay, and then second question is, explain why the audit of accounting estimates is a difficult area for the auditor. See, these two should be answered as far as the powered garden tools are available. Okay, but this is an independent question. So what if we face a lot of difficulty in answering the question number A part, then you should answer the question number B part first. You should focus on what is an independent question. You will gain 4 marks. But sir, 4 marks are nothing. 4 marks are everything, my dear friends. If you check the difference between 49 and 51 is the 2 marks only. So do not let go of the 4 marks question if you are confident that you can answer it. But for now, what I want you to do is, I want you to draft your answers for these particular two things. One is the provision for warranty claims and another one is the depreciation expense. Please frame your answers for these two. We will meet in another 5 minutes. Then we will be discussing these particular answers, and then we will be going ahead to read the answers as well. So do we need to draft the answer for part B also? No, not now. For now, just draft the answer for part A, that is point number 1 and point number 2, and you need to answer two things: what you will consider and describe the audit work that you will be doing. So it is majorly a audit procedure question only, right? So please draft this answer, and then let's see you in 5 minutes. Yes, I hope that you have drafted your answer. Now let's just try to understand how the answer should be made. Okay, so now let's try to understand for the first point first, the provision for warranty claims. My dear friends, what we need to understand is that we need to answer both, that is the consideration part and the audit work part. Let's try to understand what is the difference between these two. When we need to answer the consideration part, what we need to write down is that what all things you will inquire about or understand. What all things you would like to inquire or understand, that is very important. What all things you would like to inquire about or understand, that is very important when it comes to the discussion of the consideration part. So for example, for provision for warranty claims, what I would like to understand is what is the policy of the company when they bring their policy for warranty. What are the consideration that they have made? For example, whether the warranty is provided for 3 years, 1 year, 5 years, or what. Okay, as simple as that. Two, what is the way, the procedure to claim the warranty? All of that thing I will be understanding. So that will come under the first point of the consideration part. Second point that we need to consider is how the estimation of the provision is made within the company. How the estimation of the provision for a warranty amount is made within the company. That is very important, the second point. Then when we talk about the third point, that could be what is the intention of the management behind evaluating the warranty provision, as in do they want to be fair in that approach, or through past experiences it has been shown that they want to delay, they want to cancel the warranty claims as much as possible. We need to understand all of that. That comes under a consideration which we would like to inquire or understand about. Then when we talk about the audit work, here we need to answer assertion by assertion. Here we need to answer assertion by assertion, as in when we have to answer for audit work, what we will be doing is we will be talking about the assertion wise procedures that we will be understanding in chapter 22 to chapter 27. But let me give you some insight over here as well. We have already covered the discussion about the assertions, right? So my strategy would be that I would be writing at least one audit procedure for each assertion. So when I talk about say existence, okay, so we will talk about how we will ensure that this provision actually exists. So what we will be checking is we will might not be able to check the existence of this provision directly through a tangible source, but we will be able to check it through the flow. That is, we will be doing a movement analysis from opening to closing. Okay, then we will be discussing about the valuation. So we will be discussing about that when we talk about the increase in the valuation, that is whatever changes have been made during the year, whether that is backed by the supporting documents or not, we will be checking that. Then when we talk about the overall, this is a balance sheet item. So when we talk about the cutoff, that is very important, that whatever additions or deletions are made to the provision of warranty, then whether it has been done in the correct accounting period in which that should have been done or not. So that is how we need to draft our answers. So now the answer is for 8 marks. So how many points we need to write? So you need to write at least 4 to 5 points for the consideration part and 4 to 5 points for the audit work part. Okay, that is very important. 4 to 5 points for the consideration part and 4 to 5 points for the audit work part. That is very important. Okay, so that is how we will be drafting our answer for this. Then second part, depreciation expense on a compressed air system purchased during the year for the assembly department. So see, the question is very specific. It is not just asking you to consider and do the audit work for the depreciation expense. It is asking for a compressed air system purchased during the year only for the assembly department. So what we will be understanding over here is that what is the date of use. See, when we charge the depreciation, there has to be some starting date. So we will understand the policy of the management again under the consideration point, that when do they consider the installation date. Okay, how they determine that this is the installation date, what is the procedure that is followed. Second thing is, once the asset is in the shop floor or after the installation, how the assets repairs and maintenance are taken care of. Whether they do the repairs and maintenance regularly, then the normal depreciation should be charged, otherwise there would be more wear and tear. What is the process of accounting for charging the depreciation to this particular, whether it has been uploaded in the relevant system or not, whether it is automated, whether it is manual or what. Okay, we will also be understanding about how did we decide that what is the capitalization amount. All of that will come under the consideration point. Now when we talk about the audit work, that is again the assertion by assertion. So we will be doing the physical verification of this particular asset because it has been added during the year. So we will test the existence. We will also test whether all the particular expenses are being capitalized along with that asset which are related to this asset as per IAS 16 also. So we will be discussing about the cost as well. Then we will be discussing about whether the depreciation, we will be performing the recalculation procedure, whether that depreciation has been calculated accordingly or not, whether there are any material differences in that. So that is how we will be answering this. Now let's go to the answer and then discuss about it more. Now provision for warranty claims. So will we have only 3 to 4 points over here? No. When we talk about this particular points, then what we have to understand here is that all of these procedures that is written over here are there to teach you. You do not need to write every such procedure. What you need to understand is you need to mention it over here that when we talk about any of the procedure, those procedures are just to tell the answer. Okay, here you do not need to write all such procedure because this is not just an 8 marks question. They have mentioned all the pointers. You need to select your pointers, you need to mention it, you will be getting the marks. Now when I talk about the matter, so the company's policy for claims under warranty, you will be understanding about that. Let's go there again. 134, let's go there. 134. So see the company's policy for claims. Okay, that is very important to understand over here. The company's policy for claims, that is very important. Then the basis or assumptions adopted to derive the amount provided, because there are multiple methods to calculate the provision. Then what changes, if any, have been made to the prior year basis also. If there is any change from prior year to this year, then what is the change? Any mitigating factors which have been identified or taken into account. Then the extent to which repairs are carried out in-house, because if it is in-house, then we have to value the cost accordingly as well. Now procedures. Obtain details of client's calculations. Okay, read the terms and conditions on the sales invoices. For example, when I bought a car, there was 3 free services provided, right? So we need to read the terms and conditions also. Review records of claims received. Vouch a sample of related labor cost, whether it is appropriate or not, and whether it has been charged to payroll or timesheet accordingly or not. Consider management's expertise in determining accounting estimates via our previous experience. Review correspondence with customers requesting work to be done under warranty. Then review the terms and conditions of supplier of bought-in components. Then document and test the system for recording power garden tool returned and authorizing repairs. Vouch a sample of entries in warranty cost records. So do we need to mention all those points? No, just 4 to 5 points would be sufficient. Review consumer reports in specialist consumer magazines. Inspect the physical conditions of return tools. My dear friends, I am reading all of these pointers so that you understand everything. Just in case if you face trouble in understanding any of the pointers, do let me know. I would be happy to help you here. Now compare the level of client's insurance cover, determine the expected level of warranty allowance, reperform client's calculations, and accept the client's calculation if not materially different from the auditor's expectation. Now, if material difference as in there's a material difference, major difference, discuss with management to ascertain the reasons why. Consider effect on auditor's report if management refuse to change their estimate also. Now, when I talk about the depreciation expense, there we need to discuss about the dates during the year on which the air compressed system was delivered, installed, etc. that we have discussed, whether the system was installed by the supplier or we have installed it in-house, or basis on which cost other than purchase prices have been included in the initial cost. So that is to determine the total cost, and management's policy for reviewing and revising estimated useful life that we have discussed. When we talk about the procedures here, what we need to understand is these are again the audit procedures, that is assertion by assertion. So agree purchase price and date of supplier's invoice, date to supplier's invoice, physically inspect the asset that we have discussed, right? We have to make an assessment of actual useful life and residual value also to recalculate the depreciation. Compare estimated useful life and method applied to the compressed air system with that adopted earlier as well. Then reperform the calculation of depreciation that we have done. Then assess management's previous accuracy in estimating useful lives. So how we can do it? We can check what all assets are fully depreciated and what are the amounts of profits arising on disposal. So that is very, very important. Now with this we have completed part 1, subpart 1 and 2. Now let's jump to question number B, which is explain why the audit of accounting estimates is a difficult area for the auditor. Now this is very, very easier for you, but I would generally suggest that you draft an answer for this. When I talk about explain why the audit of accounting estimates is a difficult area for the auditor, so what you need to understand is that there are no precise measures of measurement here, precise means of measurement over here. This might be an area where management's judgment might clash with the auditor's judgment. There might be different views. So all of that. Take 2 to 3 minutes, draft your answer for this, and then let me know once it is done. Yes. Yes, I hope it's done. So now when we discuss about why audit of accounting estimates is very, very important and very, very difficult area for the auditor, let's discuss about certain pointers. When we discuss about accounting estimates, so as a nature, these accounting estimates are approximations, right? You do not have any particular solid evidence. For example, if I ask you that what is the total cost of this particular watch, you will just check the invoice, right? But if I ask you what is the provision for decommissioning, as in to bring the asset, to bring that particular asset to back to its original shape and size. Now, when I talk about this, you tell me one thing: is there any particular formula to derive that? No, right? You have to make a judgment. So that is why it is very difficult. It is more difficult than other audit procedures. Then, when we talk about the second thing, that is very important, that all of these are subjective areas. Like we discussed, a lot of times it might happen that the management's judgment and the auditor's judgment might not be at the same page here. So that is what makes it more difficult. When we talk about the third point, see, the question is for 4 marks, so you have to write at least 4 points and explain also why this is such, right? Now, when I talk about the third point, what is more important to understand over here is that accounting estimates are not just based on that this has been done in the previous year, so let's do the similar calculation this year. You have to look for the future information also. For example, the appreciation has been say 5% of the total asset cost last year. Will it be 5% this year also? No, it depends on the wear and tear, it depends on the impairment also, it depends on variety of other factors also. That makes it very difficult. So let's just now go and see what is the answer. Just in case if you face any trouble, please feel free to let me know in the chat box here, my dear friends. Now, see, why difficult? So number one is accounting estimates are approximations. So auditors are therefore more likely to need to exercise the judgment over here. This is based on forecast information rather than historic information. That is also very important. Formulas used to calculate provision must be regularly reviewed by management also, because there might be certain changes also. There might be a variety of factors that might be integrated here also. Overstated provisions create hidden results also, right? Then sufficient independent audit evidence may not be available to confirm or dispute the need for an accounting estimates. We depend on the reliability of the audit evidence, right? But when we talk about accounting estimates, say provision for decommissioning, are there any reliable accounting estimates? Maybe, but there are no externally directly obtained independent source of evidences. There are very fewer chances of that. That is why the audit evidences obtained are also of lesser quality. And although the auditor may be of the opinion that individual estimates are not materially understated, they may give rise to material misstatements also. So that is why this is very, very important. With this, we have solved the question that is available for chapter number 17. Now, after a quick break of 2 to 3 minutes, we can jump into question number 18. And my dear friends, here also we are going to solve one question that will take approximately 25 to 30 minutes for us to solve, and it is going to be a very interesting question for all of you. So let's take a 2 minutes break so that you can refresh, come to a new chapter with a new energy. Yes. Hello everybody, so let's get back to chapter number 18 with a newer energy, and this particular chapter, this particular question that we are going to solve is going to be a very big case study. So let's try to solve it with a lot of patience. I would suggest that you have a notepad or a blank piece of paper along with pen in front of you so that you can note down the key pointers and then you can draft your answers as well. Now let's try to discuss this particular question. When I talk about this particular question, this is very simple, however a little lengthy question. Now it is 1st July 2025. Okay, is it the year beginning, year end? We don't know yet. You are a senior audit manager in Suki and Company, so this is the name of the firm. Okay, this morning you have been reassigned to the audit of Bill Company. Okay, this is the name of the client. Okay, a long-standing audit client of your firm. As the manager previously assigned to the client has been taken ill, so he got ill. Bill Company has a year ending 31st July and the audit planning has been largely completed by the previously assigned audit manager. Okay, so year ending is 31st July. So you are sitting on 1 month before year end. 1 month before year end. 1 month before year end. Okay. Okay. Now, the audit planning has been largely completed by the previous assigned audit manager, Tara Lafayette, who had been recruited by a firm in March 2025. That is recently only. So she does not, or he or she might not have a lot of information about your firm's code of ethics, of firm's way of doing the operations. Okay. Bill Company is a property development company specializing in the regeneration and refurbishment of old industrial buildings. Okay, which are sold for commercial or residential use. Okay, all property developments are performed under specifically negotiated fixed price contracts. Okay, the company was founded 35 years ago by two brothers, Alex and Ben Bradley. Okay, who own the majority of the company shares capital. Okay, Alex and Ben are nearing retirement age and are planning to sell the company within the next 2 years. The forecast revenue for the year ending 31st July is $10.8 million and the forecast profit before tax is $2.5 million. So will this be important? Yes, to calculate the materiality. The forecast statement of financial position recognizes the total assets of $95 million. Oh my god, that's amazing. Now, you have just received the following email from the audit engagement partner. Okay, so this is sent to audit manager, audit senior manager for audit matter. Thanks for taking on the role of audit manager for the forthcoming audit of Bill Company. I have just received some information on two significant issues that have arising over the last week from Sam Compton, the company's finance director. That is the director's name. Okay, this information is provided in Exhibit 1 that we will be reading. I am asking you to prepare briefing notes for my use in which you explain the matters that should be considered in relation to the treatment of these two issues. Okay, so they want you to create the briefing notes for their own use. That is, it is an internal document, so you can be a little informal with your format as well. Now, and also explain the risk of material misstatements relating to them. Okay, so treatment, what we need to tell them, the treatment and then the risk of material misstatement. These two things needs to be explained. Okay, now I also want you to recommend the planned audit procedures. The third requirement, the planned audit procedures that should be performed in order to respond to those risks. See, there are two risks that they have mentioned. Okay, so we have to discuss all of that. In addition, please critically evaluate the planning that has been completed by the previously assigned audit manager. Relevant details are provided in Exhibit 2 for this, which contains notes made by her and placed on the current year audit file also. Make sure you include discussion of any ethical matters arising from the notes and recommend any actions that you think is necessary. Okay, so we have to evaluate the work done by the previous manager also. Previous manager as in the same year, in the same audit client, but by a different manager. Okay, now Exhibit 1, information from Sam Compton, finance director. In the last 2 weeks, two significant issues have arising at Bill Company. The first issue concerns a major contract involving the development of an old riverside warehouse into a conference center in Bridgetown. Okay, so development of what? Old riverside warehouse into a conference center in Bridgetown. Okay, an architect working on the development has discovered that the property will need significant additional structural improvements. That is, the property might not be very much secured, very much strength, but strengthful. So they want to make certain structural changes and improvements to it. The extra cost of which is estimated to be $350,000. The contract was originally forecast to make a profit of $200,000, but the additional cost is $350,000. So now it will have a loss of $150,000. Okay, the development is currently about 1/3 complete and will take further 15 months to finish. 1/3 is complete, further 15 months would be required. Including this additional construction work, if we do this additional construction work, then 15 months would be required. Okay, now the customer has been told that the completion of the contract will be delayed by around 2 months. However, the contract price is fixed and so the additional cost must be covered by bill company. Okay, so the customer has been told that contract will be delayed by 2 months. Okay, and extra cost will be borne by bill company. Okay, now the second issue concerns one of bill company's specialist divisions. Okay, so this is the second issue. The first issue was this one. Okay, now the second issue concerns one of bill company's specialist division which trades under the name Treasured Homes. Okay, and which deals exclusively in the redevelopment of non-industrial historical buildings. Okay, such as castles and forts. These buildings are usually acquired as uninhabitable rooms, as in where people could not survive, where people could not stay, and are then developed into luxury residences for wealthy individuals. Okay, so they take the very basic property and then they redevelop it into a very major and luxurious property. The management of bill company decided last week to sell this division, as although it is profitable, it generates a lower margin other than other business decision. Treasured Home operates separately from the rest of the business and generates approximately 15% of the revenue of the company. In a board minute dated 29th June, it was noted that interest has already been expressed in this division from a potential buyer. Okay, and it is hoped that sale negotiation will soon commence, leading to sale in September. Okay, so within 12 months it would be sold. Now there is a specific office building and some other tangible assets that will be sold as part of the deal. These assets are recorded as $7.6 million in the financial statements. No redundancies will be necessary as employees' contract will transfer to the new owners. So no employees will be let go. Now exhibit 2, which is the planning summary. So these were the two issues. Okay, what you need to do for these two issues? You need to prepare briefing notes for the use of the partner along with the treatment of these, then risk of material misestimate, and then the planned audit procedures for these two. Okay, now exhibit 2, planning summary. Planning summary, bill company, year ending 31st July 2025, prepared by Tara, manager previously assigned to the audit. Okay, now the planning for the forthcoming audit is almost complete. Time has been saved by not carrying out procedures considered unnecessary for this long standing audit client. Forecast accounts have been obtained and placed on file. See, what they have done is time has been saved by not carrying out procedure considered unnecessary for this long standing audit client. Okay, so this might be okay if there are no additional risks related to it, there are no major changes to it. Forecast accounts have been obtained and placed on file, and discussions held with management concerning business development during the year. Analytical procedures have been performed with the statement of profit or loss and comprehensive income, but not on the financial position. That is very sad. So that is the first issue, as there did not appear to be any significant movements in assets or liabilities since last year, but there should be. Now management confirmed that there have been no changes to accounting systems and controls in the financial year. For this reason, we do not need to carry out walkthrough test or review our documentation. That is very wrong. Second problem. Then management also confirmed that there have been no changes to business operations other than potential sale of treasured homes, that is a discontinuing operation or discontinued operation. All divisions are operating normally, generating sufficient profit and cash. For this reason, the business risk of bill company is assessed as low, and no further comments or discussions about business operations have been placed on file. Okay, that is very wrong, to be honest. The matter that will demand the most audit work is the valuation of properties currently under development, especially the determination of the percentage completion of each development at the reporting date. Okay, so these are the major issues that they have highlighted, so we have to note it down. Historically, we have engaged a property valuation expert to provide a report on this area. Okay, now however, bill company has recently employed a newly qualified architect who will be happy to provide us with evidence concerning the stage of completion of each property development contract at the year end. Using this person to produce a report on all properties under development will save time and cost. So we are moving towards the external expert, from the external expert towards the internal expert. Bill company has recently completed the development of a luxury new office building in Newtown. Several of the office units are empty, and management of bill company has offered the office space to our firm for a nominal rent of $100 per year. Oh, okay. To our firm also. So this could be an ethical threat also. Now, what are the requirements? Respond to the partner's email. Professional marks will be awarded for the demonstration of skill in communication and your answers that we know. Okay. Now, when Bradley have a sister, Joe, who runs an interior designing company, lantern company, during a review of the board minutes. So the above question needs to be done. Then performed as part of the planning of Bill Company's audit. It was discovered that Bill Company, let us read it again. Ben and Alex Bradley have a sister, Joe, okay, who runs an interior designing company. Understood, lender. During a review of board minutes performed as part of the planning of, board minutes are done. I thought that there's some misprint. It was discovered that Bill Company has paid $225,000 to London Company during the year in respect of refurbishment of development properties. On further inquiry, it was also found that Lender Company leases an office space from Bill Company under an informal arrangement. So first of all, the payment has been done, and then informal arrangements are there required. Explain the inherent limitations, which mean that auditors may not identify related parties and related party transactions, and recommend the audit procedures to be performed in relation to Bill Company's transaction with London Company. But how you need to answer this, let's discuss that first. See, I want the answer in 2-3 parts. Number one is this question. This question needs to be answered, which is this one. I'm asking you to prepare briefing notes for my use, in which you explain the matters that should be considered in relation to treatment of these two issues in the financial statements, and also explain the risk of material misstatement relating to them. I also want you to recommend the planned audit procedures. So treatment, risk of material misstatement, and planned audit procedure for these two issues: the development of an old riverside warehouse into a conference center, and then the treasured homes. Please try to complete this answer first, then we will be moving further. So what is the marks given to this particular answer? So the marks given is 14 marks for this particular answer. 14 marks are given for this particular answer. That is very important for us to understand. 14 marks plus 9 marks for the second one, but please try to evaluate this one first. Both issues are there, 3 points are there, so total 6 points. Marks are for 14, so roughly 2 points for each, okay, roughly that. So I'm opening this. Please try to complete this particular part. Let's take a 5 minutes break, then complete this part, and then we will be meeting again. So in 5 minutes we will be meeting. Please draft your answer for this one, and then we will be discussing about it. Hello, my dear friends. So now let's come to this particular question, but the real question is why this question is covered under the work of others. Because see, here we are not just talking about the work of others. This is a completely different case study. But my dear friends, once we solve it, you will get to understand that why this particular question is covered under the use of others as well, under the work of others as well, and why this particular question is a mix of a lot of other chapters as well. My dear friends, first, let's try to understand that this particular question could have certain knowledge from your SBR as well. When we talk about the SBR knowledge, where it is coming from here is, see, let's try to understand. The estimated additional cost is 350, whereas the original forecasted profit was 200,000. So 150,000 gap, that is $350,000 additional cost less $200,000 of profit, that makes extra cost of $150,000. Now my dear friends, this is that one cost which makes this particular contract onerous contracts are there, right? So this will not be covered under IFRS 15. This is an onerous contract, right, under IAS 27. So that is very, very important for us to understand. But sir, is this amount material? So there were certain revenue figures that was given to us. Let's check it. Where was it given? Let's check it. There were certain revenue figures that was given to us, right? See, this one. The forecast profit is $2.5 million. This is $150,000 divided by 2.5 million. So this will give us 6%, right? This will give us 6%. Let us check also. 150,000 divided by 2.5 million. Yes, that gives us 6%. So this is very, very important. 6%, that is material, right? So that is the first thing that we need to understand over here. And what we need to tell them, we need to tell them about the treatment, about the risk of material misestimate and the planned audit procedure. So my dear friends, treatment is the result of the risk of material misestimate and planned audit procedure only. So first risk is that this will make the contract onerous. We have to still complete it. We have to review the agreement with the customers, because it has been specifically mentioned that all the additional cost, it's a fixed price contract, so all the additional cost would be borne by the company only. So we will have to incur that additional cost. We might also be delayed in our approach, because it was mentioned that we have not fully communicated the delay that is required. We have only communicated 2 months, so there could be certain penalties regarding it also. So those are the risks. And the audit procedure that we need to perform is, we need to verify the agreement. We need to understand from the client that whether they will be charging us any penalty, whether they have any willingness to do that. If yes, we will have to make the provisions for that as well. Otherwise, now we have to make the provisions for the onerous contract of $150,000. So all of these are the procedures and planned audit procedures and risk of material assessment for this. Now when we talk about the second point, which is the treasured homes. Here what we need to understand is, when we talk about the treasured homes, so here some of the important pointers is that these are redevelopment of non-industrial historical buildings. So this is again going to be a very heavy cost for us. That is one consideration. Okay, now we have decided to sell this particular division, so it will again be considered under a group sale, right? So that is very, very important. Then it also has the major revenue. 15% of the revenue is considered as material. Okay, the sale is supposed to be completed in September, so we can recognize it as assets held for sale. And discontinued operation, we can recognize it from there. Okay, so all of these things makes this particular point very, very important. Now how will you perform the audit procedures on that? So we will be performing the audit procedures as far as the verification of agreement is there, the letter of intent from the potential buyer is there, how they will be doing the treatment of the $7.6 million of assets, that is going to be very, very important. So all of these points make this particular answer very, very important. Now let's go to the answer as well, my dear. See, when we talk about the first point, which is the Bridgestone property development, let's discuss about that. So what all points are mentioned over there? Okay, it's a loss making contract and it is covered under IAS 37, that we have covered. Okay, unavoidable cost of fulfilling an obligation should be considered when identifying the cost. We have already covered it, $150,000, right? This one, $150,000 of loss is now expected to arise. Okay, Okay, if there is any late completion penalties, then we should make a provision for that as well. Okay, then okay, this includes 6% of the profit. So this is material also. $150,000 represents 6% of the profits, like we have calculated. So all of these were the pointers. Now planned audit procedures. Obtain and recalculate the budget for the Bridgestone development to verify the accuracy. Okay. Examine the customer signed contract. Inspect the list of provisions to be included in the accounts at the year end and whether this particular provision has been included or not. Inspect any report made by the architect regarding the structural improvements, like we have discussed. Discuss the additional cost with contractors or relevant employees to assess if estimate appears reasonable or not. That is whether it would be done within $300,000 or not, $350,000 or not. Review the additional cost for any costs that are avoidable. Review bill as in bill companies cash flow forecast to ensure adequate funds are there to cover the additional cost, whether you have the $350,000 or not. Inquire if any quote has been received regarding the additional cost or not, and whether the amount matches or not, and consider using an expert to obtain evidence regarding the completeness of the estimated additional cost plus percentage of completion also. Now, and recompute the forecast loss also. Now, when I talk about the treasured homes, certain points are very required to mention over here. That is, it is 8% of the total assets. Okay. Uh, the assets are available for sale in their present condition and the sale is highly probable, and these conditions are met before the year end also. Okay. Since buyers are interested, negotiations are happening and are about to be completed by September also. So the asset should be presented separately, measured at the lower of carrying amount or and fair value less cost to sell, that we understand from our IFRS 5 also. Okay. Then there's a risk that the disposal group is not disclosed in the financial position, the statement of financial position, that is, it is not disclosed separately. That is one risk. Okay. Then the division contributes 15% of the total revenue, so arguably represents a major line of business also. Yes, that is very important to understand. Comparative figures should also be restated. That is, if you will be showing it separately in the statement of financial position, the relevant last year figure should also be separately disclosed. A further disclosure risk arises from the requirement to disclose the net cash flows of the discontinued operations as well, because there's a requirement and they might miss it. Now, when we talk about the planned audit procedures to address these risks, it would include review and file a copy of the board minutes to sell this particular division, whether it is approved or not. Inspect, let me save it here. Inspect any documents pertaining to the sale negotiation, the agreements, the letter of intent, like we have mentioned. Obtain management's calculation of the fair value less cost to sell and whether they have been recognized as the correct amounts or not. Inspect forecast and budgets for the year ending 31st July. Confirm that separate disclosures have been made in the statement of financial position for this particular separate class of assets. And then confirm that depreciation has not been charged and that comparatives have been restated in the statement of profit and loss. With this, we have completed the first part of the question. So, are these case study questions asked in the examinations as well? Yes, definitely they are asked. So, you cannot let it go. It is definitely asked. Now, let's go to the second part. Okay, this is a 9-mark question. In addition, please critically evaluate the planning that has been completed by the previously assigned audit manager. Relevant details are provided in Exhibit 2, which contains notes made by her and placed on the current year audit file. Make sure you include discussions of any ethical matters arising from the notes and recommend any actions you think necessary. Okay, so Exhibit 2, it's this one. We have mentioned certain points over here. Here we have not mentioned any points, but here we have mentioned certain points. So I'm trying to present it here. If you have the book also, please read the first paragraph from the book, and then these are the points where the major issues are mentioned. So take 2 to 3 minutes. Since we have already discussed about it, take 2 to 3 minutes, draft your answer. Let me know on the chat box once it's done, and then we will be moving further to the discussion of this particular question as well as the answer writing of this particular question. Yes, my dear friends, I hope it's done. Please confirm me on the chat box. Yes. Okay. So now let's discuss about what could be the answer to this one. See, my dear friends, what we have to mention is that a lot of things have been missed or has been done inaccurately, inappropriately by this previous manager. So we have to just highlight that. Okay. So inadequate procedures are not completed on the statement of financial position. That is one point that you can mention, like we have mentioned earlier as well, right? Understanding of the internal controls along with the walkthroughs, test of control should also be done. Okay, and documentation should be done. That is the second and third point. Okay, then property valuation experts guidance is much important to determine the percentage of completion. If it is done internally, that might not give us the indirect and the reliable source of evidence also. Okay, just to save time and cost, we cannot do so, right? So all of these things are very important for us to mention it. Now let's see what they have mentioned. So they have mentioned, okay, the managers seem to have been more concerned with saving time and reducing cost. That is not good for the overall audit. Okay, the manager's notes indicate that some procedures have been performed, but none relating to assets or liabilities because they are not performed in relation to the statement of financial position. Okay, so that is also that has been mentioned. The auditor should also obtain an understanding of internal controls, like we have discussed. Okay, the risk assessment process must be documented also, that they have not documented. Okay, it is the right of our firm. It is right that our firm should use the work of an expert to obtain evidence regarding the stage of the completion of the development properties at the reporting date. This work requires specialist skills and experience beyond the expertise of the audit firm. Therefore, the competence, capability, and objectivity of the management experts must be evaluated, and that is why this particular question is mentioned over here. Okay. Also, as a new recruit, the architect may want to create a favorable impression and could be subject to considerable influence also, because they are internally generated documents, so much not very reliable for the audit firm. Finally, Bill has offered office space to a firm at a nominal rent of $100 per year, which for a luxury office building must be significantly below the market rate. Any offer of goods or hospitality may create self-interest, familiarity, or intimidation threat to objectivity and independence. That is why this cannot be accepted also. However, as the rental charge is very small compared to the likely market value, this is unlikely to be the case that it is inconsequential. Okay, the audit firm should definitely decline the offer and explain the reasons for this to the management of the bill also. With this, we have completed this part. Now let's jump to the next part. Okay, let's jump to the next part. So if we do not give this much of details, is it appropriate? See, you cannot miss the conceptual pointing, but the explanation part, if they have given in 5 to 7 lines of the book, you do not need to write 5 to 7 lines. You can write in 2 to 3 lines also, so that is also fine. But the points should be covered, the relevant pointer should be covered. So what if there are 9 pointers and the answer is for 8 marks only? Still you need to write all 9 pointers. Do not worry that for 8 marks you only need to write 8 points. Okay, now explain the inherent limitations, which mean that auditor may not identify related parties or related party transactions. That is one thing. And recommend the audit procedures to be performed in relation to bill company's transaction with Latin company. So this is 4 marks each. Take 5 to 10 minutes, 5 minutes, not 10 minutes, sorry, 5 minutes, draft this answer, then let me know, then we will be discussing it, and we will also go for the answer reading, and with this we will be completing this question and this chapter as well. This was a very long case study, but a complete one. Okay, so I hope that this was a sufficient time to draft the answer. Now let's discuss about it, my dear friends. When I talk about the inherent limitations, that is pre-existing limitations, right? Regarding not just the audit procedures but regarding the related parties and related party transactions only. So this is a very specific question, my dear friends. Inherent limitations could include that management might not be aware about it. See, company might be 100 years old, 150 years old, management might be new, they might also not be aware about. Sometimes it might happen that they might also not be aware about the complete related party transactions. So how they will inform? There could be ill intention on the part of the management also, that they do not want to disclose certain relations. Then certain relations might be very difficult to identify also, right? So all of these points are very important in the inherent limitations. Now when I talk about the audit procedures, so for audit procedure, whenever it is asked, although we will be getting trained in chapter 22 to 27 for this, but if I give you a hint, you have to follow that ICAI ORR approach. That is, you have to inspect. What you will inspect? You will inspect the arrangements. So you will inspect the documentation, supporting documentation of this particular transaction that has been done. Okay, so the agreement could be there and all. Then you will take the confirmation also. So for this, confirmation is not possible for such a transaction. Then what you will do? Analytical procedure. So what you will do? You will take the cost that has been incurred for this particular related party company, and you will take the cost that is industry average for such a transaction. You will compare it. You might also see that whether that cost is justified, not just via industry but via the repetition, via the calculation that should be done by a normal person of normal prudence, ordinary prudence. Then what you will do? You will inquire also. You will inquire also. What you will inquire? You will inquire that what is the length of that particular transaction, whether that transaction has something that has not been disclosed. So you will inquire with the management of both the companies, maybe, right? That is very important. Then you will do observation. What you will observe? You will observe whether the work for which the payment has been done to the related party, whether that work has actually been done or not, right? That is very important. And if it is in the continuous process, you will observe whether it is continuously being done or not. Then you will recalculate the amount. See, there is percentage of completion also. Say there is the completion stage also. You will recalculate that whether the amount that has been given, say per hour fees is given, so whether that per hour fees and whether the total amount matches or not, right? So all of that is very, very important. Now let's go and read the answer. Okay, so when I talk about the inherent limitations, so can be difficult to identify. Okay, management might be unaware also. Okay, okay, it can be difficult to identify also, as some of the definitions are subjective. Correct. There could be deliberate attempt on part of the management to conceal the related party transactions or relationships. The accounting system may not be set up to identify related party transactions sometimes. Yes, that is why in case of a lot of advanced software, the family tree of the company is inculcated, and whenever there's any transaction with the related party, they only highlight it. The audit the accounting system only highlight it. Okay, some related party transaction occurs at that minimal amount also, so that is very important. Here we have not covered that particular point of the office space that we were talking about while reading the case study. So review in what are the audit procedures now? Review invoices received from lender to verify the amount of the expense. Okay, confirm cash payments, inspect trade payables accounts to confirm any amount outstanding, compare the cost of refurbishment at the cost of refurbishment carried out by other suppliers, whether they are charging extra or less, discuss the informal lease with management and obtain a written representation regarding the nature of the arrangement and whether any amount is payable to bill, confirm through inquiry with management that the date of the lease arrangement commenced and the expected period of the lease, inquire if any written documentation exists regarding the lease arrangement also, even if it is informal, review the disclosure made regarding these transactions in the draft financial statements, whether the relevant disclosures have been made or not, or is there any other point. So what if we write a little different point than what has been written over here? That is perfectly allowed. That is not an issue, but your point should make sense from the point of an experienced auditor. That's it. Now my dear friends, with this we have completed chapter number 18 as well. Now we will meet tomorrow to complete the chapter number 19 as well, 19 and 20 as well.